Good morning, everyone. Thanks for joining the weekly US macro call. My name's Abigail Watt, one of the economists in the team, and today I'm joined by my colleagues Alan Detmeister and Sonia Meskin. Just a small kind of housekeeping reminder, if you would like to submit questions, you should be able to do so online, and we'll be able to get to those at the end of the call. But thanks everyone for joining. I think obviously the kind of clear news from last week was the stronger than expected gain in employment in September. But we also heard from a number of Fed speakers, including Chair Powell, and then I think there's some interesting points to note in the claims data. But I think starting with the employment report is a good place to start. I'm just going to quickly share my screen. Here we go. So hopefully everyone can see this graph, because I think it's an important part of what we saw in the employment data last week. So obviously we saw non-farm payroll employment expanding 254,000 in September, and there were cumulative kind of 72k upward revisions to the prior 2 months, and that did leave behind a stronger contour for employment gains. When we look at the kind of 3 months moving average of employment gains, if we look at the August level of that was revised from 116k to 140k with those revisions. So generally we saw kind of an upward revision in terms of the contour of employment in the latest jobs report. And alongside that, we also saw the unemployment rate ticking back a tenth to 4.1%, with a relatively strong gain in household survey employment as well. In terms of the other details, average hourly earnings rose 0.4%, and that was potentially supported by a 0.1 hour decline in the work week to 34.2 hours. But I think one of the main things that we noted in our kind of publication on Friday when we were writing up the employment report is that we think we've seen kind of a new seasonality emerging in a number of US data series. One of the things that we've seen is diminished seasonal amplitude around the winter and the summer that could be a result of kind of the economic center of gravity shifting southwards in the US. And this pattern with kind of slower summer inflows, as you can see in the chart, and then also kind of slower outflows at the end of the summer may have supported some of the employment growth that we saw in September. And then when we look ahead to October, we think that some of this kind of seasonal pattern, but as well as kind of temporary factors such as storms or strikes, may potentially weigh on the October report when we kind of get there. But generally, we would suggest that we should kind of smooth through some of the kind of monthly gains that we've seen. And if we look at the kind of 4-month moving average and job gains, that's sitting at around 169,000 per month. If we look at the 6-month moving average, it's sitting around 166,000 per month. And that seems roughly consistent to us with kind of the slowing that we've seen in kind of real GDP in the kind of broader economy. I think the other thing that I would note from last week that was obviously important was we did hear Chair Powell speak. He spoke on Monday, obviously well ahead of the employment data, but he seemed very comfortable kind of reiterating the summary of economic projections, saying that the FOMC's base case would be 2 25 basis point cuts at each of the remaining 2 FOMC meetings this year. He also kind of leaned a little bit more on the kind of strength that we've seen in final demand recently, and at least on the margin, kind of made the concerns that we had heard about the employment report about the labour market ahead of the employment report on Friday sound a little perhaps less worrisome in his comments made on Monday. Of course, he did say that future policy decisions would rest on the data to come, and that includes the kind of employment report that we kind of had on Friday, but also the kind of upcoming CPI data this week. In other Fed speak last week, speakers generally reiterated previously held views, and we continue to see this kind of split among participants around those who are kind of more concerned over the kind of labour market outlook and those who are perhaps more focused on the sustainability of the declines we've seen in inflation thus far. So it will be important to listen out to the kind of Fed speakers that we have this week to kind of see how views are maybe potentially changing given the kind of strength of the employment report that we saw last week. And then finally, just for me on the kind of week in review, last week we saw initial claims rising 6k to 225k in the week ending the 28th of September. I just wanted to note that we do think we could be reaching a low point for the trending claims as residual seasonality and storm and strike disruptions are expected to kind of push claims a little higher in coming weeks. We also are looking out for the kind of Boeing strike that we've seen. It appears to be idling upstream suppliers, and claims filings have been rising in Washington state. So there's some potential for this to kind of spread through the supply chain and affect a range of states across the country. We also didn't necessarily see storm-related claims filings showing up in the data strongly last week, but there is potential that we may begin to see those showing in the data published this week. And then just as the chart shows here, figure 13, the post-pandemic pattern of diminished seasonal amplitude has also led to the kind of 4-week moving average of claims to decline and trough in each of the past 3 Septembers before rising again. So this would be consistent with us potentially reaching the kind of trough there in the claims data. But that's it for me on the kind of week in review, and I'll pass back to you, Sonia.
Hi guys. So I actually only have some expectations for the FOMC minutes and Fed speak until I pass it over to Alan to cover the CPI, which we think will be the focus of the week. So on the FOMC minutes, it would be very interesting to see whether there's any more color on how united versus divided the committee may have been around the 50 basis point cut. Of course, the chair referenced in the post-FOMC press conference that the committee was fairly united around this decision, but the SEP to us may have suggested otherwise. So any color that we can get from the minutes around that wedge and what that means for the path forward, we think would be useful for us in the markets. Furthermore, we're going to get a lot of Fed speak this week. We largely anticipate that folks will support a further 25 basis point cut in light of the strength of the employment report for November. But of course, it's not all and be all. We're going to have some more data between then and the recent NFP. And with that, I'll pass it on to Alan to cover inflation.
Thanks, Sonia. So we put out our U.S. CPI preview on Thursday last week, but then we put out an update this morning that incorporated the September Adobe Digital Price Index data that became available on Friday afternoon. With this update, it nudged down our expectation, and we're now looking for a 10 basis point increase in the headline CPI, really right in line with where the Bloomberg consensus was as of last night. So it makes our forecast kind of a little boring on the headline numbers. It's more fun to be a little different from consensus. For the core, we're looking for something a little above consensus. We're at 27 basis points, down from the 31 basis points that we put out last week. Bloomberg consensus as of last night was at 23 basis points. So both of us are still expecting a solid number. We're a little bit stronger than consensus on that. I should also note that our headline number is consistent with the swaps at the moment. Swaps quotes as of Friday night, we were getting around 9 basis points. So the 10 basis points that we have, which is the same both seasonally adjusted and not seasonally adjusted, is only a basis point different from swaps. The main thing leading to the fairly soft headline number compared to the more strength in the core number is that we're once again seeing gasoline prices that are falling pretty decently this month. On the other hand, we're seeing food prices that are right in line or would not be out of expectations on the pre-pandemic pace. For the core, this 27 basis points looks to be fairly similar to the 28 basis points that we saw last month. We do expect that the inappropriate part of the seasonal factors that have swung around since pre-pandemic should add about a basis point, not a big factor this month. That said, due to a change in used car methodologies that was introduced at the beginning of this year. The not seasonally adjusted core CPI number in September should be well above where we were last year or in the pre-pandemic years. So while the seasonally adjusted core CPI number is very similar to where we were last year, the not seasonally adjusted core CPI increase will be above where we are last year. And since why that matters is that not only is because swaps are quoted on not seasonally adjusted basis, but also that the 12-month change is derived from not seasonally adjusted numbers. So we will be seeing the 12-month change for the core CPI rising from where it was last month, up about 15 basis points this month. Now, core goods are expected to be relatively flat this month after declining 14 of the past 15 months and all of the last 6 months. The main reason for the more strength this month is that used vehicle prices, which have been a significant negative through most of this year, are now going to start being a positive this month and even more so next month. Now, we already have the October J.D. Power used car guide data in hand, so that means that next month's increase of about 2.25% on the used car prices is a pretty solid number, though it may change around a little after we get the CPI. We're also expecting new car prices to be a bit positive, but other core goods prices to still be a negative number this month. And that was the big data that we got in from the Adobe data released Friday. We had expected these core non-transportation goods to be a positive, but particularly for the information goods and a little bit for some of the other components, the Adobe data came in on the weak side of our expectations and drove that down. We have been very surprised that we have not seen more pass-through from the strong international freight shipping costs that we had from December up through June, that has not led to more strength in these core goods prices outside of transportation. Now, we are seeing those prices come down for the freight shipping costs pretty solidly since July, though given the pass-through, those international freight shipping costs still should be a bit of an upward push to core goods prices through the end of the year. On owner's equivalent rent, we got a pretty strong number last month. We're expecting that to pop back down to about a 39 basis point increase, still a solid increase, but well below where we were last month, and then kind of bounce around between 30 and 39 basis points for the remainder of the year. In particular, we are still seeing new lease rents running a little bit below their pre-pandemic pace. According to Apartment List, for some of the other indexes, they're running very similar to their pre-pandemic pace, which are these three gray lines. Now, for the core services excluding rents, we're looking at 35 basis points in September, very similar to, I think it was a 33 basis point increase that we got in August, so not anything surprisingly different there. There is a few changes under the hood, with medical prices coming in a little bit stronger, but things like lodging away from home, airfares coming in a little weaker than last month. So on the 12-month changes, we expect the core CPI to move up a tenth, headline CPI to move down a tenth, so that we're in the range on those 12-month changes of 2.4% for the headline CPI for 12-month inflation and 3.3% for the core CPI. For the Fed's preferred inflation index of PCE prices, we're looking at the core PCE at 17 basis points, so right along a 2% path this month, with the headline at 8 basis points, so below what is consistent with the FOMC's 2% target. The very interesting part of that is that we should get 12-month headline PCE inflation, which is technically, the FOMC's official inflation measure hitting their 2% target this month. If we're surprised on the downside, we could even see it slip to 1.9%. That said, core PCE inflation is still going to be a little elevated, but at the lowest level we have seen that in the last 3.5 years, slipping to 2.5%. Looking into future months, we are expecting to see some strength next month with the headline CPI moving up to about 25 basis points, but more strength in the core at about 32 basis points. That's being driven by that stronger increase in used cars, also because we think the seasonal factors are going to add a lot more next month, about an additional 6 basis points to the core CPI change. So that means that that 2% hit of the FOMC's inflation target is likely to only be for 1 month. We're expecting it to pop up above that target through the remainder of this year before settling back down to close to that 2% target around February of next year. So overall, a fairly weak number for the headline CPI, a little bit of strength with the core CPI numbers. That number for the headline is right in line with consensus and swaps, but we're a little bit above with the core. So I will leave it there and pass it back to you, Sonia.
Hi, guys. That pretty much concludes what we were looking to cover today. Are there any questions for the team? I don't see any on my end.
I do not see any either.
All right. Thanks so much for dialing in today, and we will see you next week.